I now hand the conference over to Mr. Abhishek Singhal. Thank you, and over to you, sir.
A very good afternoon to all of you, and thank you for joining us today for Solara Active Pharma Sciences earnings conference call for the fourth quarter and full year ended financial year 2021. Today we have with us Mr. Bharat Tesha, Solara's MD and CEO, and Mr. Subhash Anand, Executive Director of Finance and CFO, to share the highlights of the business and financials for the quarter. I hope you have gone through our results release and the quarterly investor presentation, which have been uploaded on our website as well as stock exchange website. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Bharat to make the opening remarks.
Thank you, Abhishek. Good afternoon, everyone. Thank you for joining this call today. It's with a sense of deja vu that we are all dealing with the second wave of this pandemic now. I wish you and your loved ones lots of good health as we fight this pandemic together. It's somber times, and we are fully conscious of this and are taking all measures to support the community and keep our employees safe and healthy. Coming to our results, delighted to share with you that Solara has delivered a landmark year. Our FY21 performance has been one wherein every quarter we've built on the solid successes and the foundation has been laid over the last couple of years. We focused on accelerating growth over the year, and we have delivered on that count. This year has been one with its share of challenges. As we all know, it started with the lockdown and the consequent need to ensure our employees were safe and healthy while focusing on living up to our commitments to our customers and to broader society. I'm very proud of how the Solara team has delivered on all of these things consistently day after day. Coming to our Q4 results, the diversity of our geographical presence and the strength of our product portfolio enabled us to navigate Q4 quite well. Our Q4 performance was underlined by revenues of 4,540 million INR and an EBITDA of 1,051 million with a margin in EBITDA of 23.1%. This has led to a PAT of 566 million INR. The year-on-year growth of these numbers were 47% on revenues, 74% on EBITDA, and 218% on PAT. Our FY21 performance was underlined by a revenue of 16,457 million INR and EBITDA of 4,004 million with a margin of 24.3% EBITDA. This has led to a PAT of 2,213 million INR. The year-on-year growth of these numbers were 22% on revenues, and if you exclude ranitidine, it would be 30% growth in revenue, 43% on EBITDA, and 93% on PAT. Let me talk about the underlying performance drivers that we have had over this quarter. There has been a strong performance in other markets and continuing increased presence in the regulated markets. We've been able to successfully enter into multiple new customers and markets, including for the production that we have ramped up in Vizag. And I'll come back to Vizag in a couple of minutes. We've anchored our regulated market presence quite well, and we are excited about further opportunities that we are currently in the final stages of concluding with new customers for multiple new products. We've also been successful in maintaining a share of wallet with key customers for our base business. Our cost improvement actions, both in supply chain and in operations, continues to be a pillar of strength. And our R&D velocity has increased significantly. This year, we filed 8 US DMFs, which is double of last year's total, and 3 EU DMFs. The total last year was 5 between these two. Our market extensions, which I would say is a means of efficient growth for FY21, stood at 23 across multiple global markets and regions. Coming to our CRAMS business, We continue to track to plan on our CRAMS business. We have seen repeat opportunities come in from big pharma companies, and we are continuing to deepen our engagement with them. There was a one-off delay in offtake of volumes by a couple of our customers, which we are confident will normalize over the coming months. We continue to have very good revenue visibility for the CRAMS business for the next 3 quarters, and overall, we expect the CRAMS business to grow at a faster growth clip than the overall company. Let me talk about the Vizag facility. The commercialization of the Vizag facility is going on in a calibrated manner. We have doubled our utilization rates from Q3 to Q4. What is exciting also is that we have accelerated and are progressing really well towards validating and commercializing a multi-purpose facility at Vizag. This will happen in this Q1 FY22. This facility will have the capability to produce a COVID-related molecule, favipiravir. With this facility commercialization concluding in Q1, between Aurora and Solara, we would have one of the largest capacities for favipiravir API. This is a great example of how we have nimbly reacted to a very clear need in society, and we will bring a product to our customers which is also highly needed by society in record time. In addition to this, we are also working together with Aurora on other interesting molecules that include ones that are related to COVID therapy. These initiatives will nicely marry Solara's assets with the rapid product development capabilities that both companies possess. Let me talk about our strategy and the future. A key milestone in the future success for Solara was the recently announced merger with Aurora. Just want to remind all of us, this merger has added significant momentum to the execution of our strategy. It is EPS accretive immediately, and it fills in very nicely some of the strategic priorities for Solara. We have already initiated with a leading consulting firm the process of identifying synergies at a more granular level, and once we get the approvals from shareholders, we will get into more details and share this with you at the appropriate time. But the initial analysis looks really exciting and bodes really well for our future. In addition to this, we also make steady headway in developing technology platforms, and we are on track for executing the proof of concept for at least 2 of them by the end of this financial year. A couple of new products that we have launched in FY21 are all set for scale up in Q2, Q3 of FY22, and I'm delighted to say that we have confirmed orders for the entire year already for these products. We also have additional exciting products in our pipeline which will be moving into validation phase in FY22 and will support our growth not just in FY22 but for many years beyond. I'd like to end by saying that we all are dealing with the second wave in India. Various parts of the world are in different stages of fighting this pandemic. There is a need for us in Solara to continue to focus on costs, customers, differentiation, and keeping employee safety and health as number one. Our business model of strategically partnering with our customers on a long-term basis, our product portfolio breadth, and a solid position that we have in many of our products will enable us to successfully deal with the market dynamics. I'm very confident that with the depth of our product portfolio, the growth in new products, and a significant acceleration in our CRAMS business, our FY22 will gain momentum as the year progresses. I would ask Subhash now to share some details on the balance sheet and other key ratios.
Subhash, sir, may I request to unmute your line from your side and go ahead?
Sorry. Am I audible?
Yes, sir.
Okay. Good afternoon, everyone. As you have seen in last 3 quarters, the financial ratios have continued to improve consistently. Just to share with all of you, the board has recommended a final dividend of rupee 3 per share, With this, the total dividend for FY21, including interim dividend, will be rupees 7 per share, that is 70%. Yes, the final dividend is subject to shareholders' approval. Capex for this year is at 174 crore. This continue to reflect our focus on growth-led investment. Asset turn for FY21 stood at 1.8x, up from 1.7 in the previous year. In fact, 1.8x asset turn is with Vizag. If we take out Vizag, because Vizag contributed part of the year, our asset turn stands at 2.1x. This reflects the leveraging of asset and high utilization which we are able to achieve during our current year, and also reflect the potential of asset utilization what we have in future if we continue to perform the way we are. Net asset increased from 783. Net asset increased by 783 million from 441 crore to 522 crore. Contributed by higher receivable this quarter, primarily led by 2 or 3 reasons I call it. One, yes, the sale in this quarter is much higher compared to last quarter as well as the last year. As Bharat indicated, our YOY sale is up by 43%. That has resulted receivable. Other thing, our sale to LRM market has increased, and LRM market being led by slightly higher receivable in terms compared to regulated market, that also has impacted higher receivable as of 31st March. Plus, we have a outstanding because of GST and export incentives which were expected to be normalized in the coming quarter. Net debt as of 31st March are at 408 crore after adjusting the surplus cash of 199 crore as of 31st March. While our net EBITDA ratio continue to be comfortable at 1x, ROC stands at 17.9%. If we take out Vizag asset, then our ROC now is at around 21%, which is almost benchmark compared to the industry. With a healthy balance sheet ratio and fresh infusion of capital and abundant opportunity, Solara is positioned exceptionally well for the future. That's what we have for this quarter on a financial ratios and commentary. Back to you. We can open up for Q&A.
Neeraj, can we start the Q&A, please?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Alankar Garude from Macquarie. Please go ahead.
Yeah, hi, good afternoon, everyone. So my first question is revenue ramp up from Vizag appears slow, and that's reflected in just 4% sequential growth. And you also mentioned about calibration in ramp up of Vizag. So firstly, can you elaborate a bit on that? And secondly, I think in Feb you had said that you expect to reach optimal utilization in 3 to 6 months from then. So what would be our revised expectation?
Thanks, Alankar. So on the first question, when I say calibrated, what we were doing is we were placing our product in markets where we had made strategic choices to enter. And so that's what I meant by calibrated. So our revenue from Vizag has scaled up. As I said, the plant utilization is doubled. So last year quarter, if you recall, I had said roughly around 1/3 was a plant utilization. Currently, we are roughly around 2/3. We are fully capable of ramping it up in the next 3 months. So the guidance that I gave on full ramp up is still valid. We are currently in the process of the final ramp up phase, and we will be on track when it comes to ramping up to full capacity in the same time frame I had indicated last time.
Understood, sir. So, as of now, there are no challenges which you are facing because of the second COVID wave, specifically pertaining to Vizag?
No, we're not. We have been very, very careful in that. We've tried to take all precautions, so no impact at this point in time from a second wave.
So one follow-up to that, we had also said that we are looking to possibly resume or possibly start regulated market sales from this facility towards the end of this fiscal. Now with the second COVID wave, is there a possibility of a delay on those lines?
So the picture is a bit hazy currently because that lies entirely with the regulator, but we have a couple of opportunities to ensure that we mitigate that risk. Countries are now more flexible with remote audits. We are hopeful that we will be able to get those solutions in place for us to be able to get regulatory approvals before the end of the fiscal. That's still the operating assumption, and we are working towards that aim, Alankar.
Understood, sir. So my second question is, we haven't provided any guidance for FY22, and possibly that's because of the merger. But is it possible to provide any qualitative comments on how FY22 is likely to look for us?
Sure, and you're exactly right. We want to come back to you once the shareholder approval is there in much more detail about the synergy opportunities and the combined entities outlook for the future. That's the reason we have not given you specific guidance for Solara this quarter for the future. But qualitatively, there are three cylinders of growth that Solara has, and all three are in good shape. And that is basically the base business, where we are in share of wallet wise, we are at the right customers with the right share of wallet. New products, I had talked about in my opening remarks. We're excited about a couple of new products that are scaling up this year. We are fully booked in terms of capacity for those products with customer commitments. And our CRAMS business, where I see strong revenue visibility, stickiness with our customers, particularly big pharma companies. So qualitatively, I can say we are in the same momentum of growth that we have experienced this year. We will continue to feel that momentum of growth going forward.
Thank you, sir. And one last question, if I may. Can you comment on the status of expansion of the Mysore facility and any thoughts on our backward integration initiatives for FY22?
So this will be covered as part of the synergy discussions, Alankar. So this is definitely one of the key topics that we see synergies play out after the merger, because we have possibilities to backward integrate from both companies' products, and we have the land to be able to do it in Mysore. So we'll come back to you specifically on this question, but it's a high attention point, and we see quite some exciting opportunities there.
So, but on that, so we had already announced the capex for Mysore, right? So, are we putting that on hold till we firm up our plans, the merger plans, or?
So we had not specifically announced a capex for Mysore. We had said that we will be building intermediate capacity there. Now we will just kind of incorporate some of the additional opportunities we get for that intermediate facility, and we will be investing in Mysore on the intermediate capacity, Alankar.
Understood, sir. That's all from my side. Thanks and all the best.
Thanks.
Thank you. The next question is from the line of Shriram Rathi from ICICI Securities. Please go ahead.
Yes, thanks for the opportunity. Just a couple of questions. Firstly, on the CRAMS business that you mentioned for the next 3 quarters, the visibility remains very strong and they're already back on track in Q4. So does that mean that we will be back to FY20 levels, or it could even go higher from that level?
So, as we have discussed during the previous quarterly call and then in the merger announcement, the CRAMS business is well on track. So we will grow faster than the overall company does in the coming period, 2-3 years. To answer your specific question, will we be back to where we were in FY21? We hope we will be better than we were in FY21 in CRAMS business based on the visibility that I have. I also mentioned in my opening remarks that a couple of our customers who take quite good products of a good margin and good revenue had delayed their offtake one time. It's not structural, it's situational because they had other priorities when it came to COVID molecules. That is also normalizing now. So I'm quite confident we will deliver good growth in CRAMS this year.
Okay, got it. And secondly, sir, on the gross margin this quarter, we have seen some dip, and that is also getting reflected in the EBITDA margin to some extent. So any specific reason for this gross margin dip, or it is like one of quarter?
So there are a couple of reasons for it. One is the fact that we were able to move Vizag product into the less regulated markets. Obviously, had an impact because that would mean that lower margins that we were typically gotten in the regulated markets, this would be lower. Second, there was less sales to the regulated markets on some of the base molecules, and that is entirely related to the fact that people were just normalizing demand after COVID. Stocks were being run out by some of our customers. Both these trends we will expect to normalize. So those were the key contributing factors towards the margin change from last quarter to this quarter.
Okay. So just an extension to that, so basically like going forward FY22, is it fair to assume that like FY21 base overall for the full year of gross margin and EBITDA margin should be sustainable or may improve from here on?
Sorry, can you say that again, Sriram? I missed the last part.
Yeah, so I'm just saying that going forward in FY22, is it fair to assume that the gross and the EBITDA margin level of FY21 should be sustainable and can improve also from here on?
Yeah, so we've always been guiding that we should be looking at the 23-25 range for EBITDA, and we will continue to be able to deliver those type of margins.
Got it, sir. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Cinderella Thomas Carvalho from Centrum Broking Limited. Please go ahead.
Thanks for the opportunity. I guess I had a question on the guidance, but you have already alluded to it that we need to wait for it. Just the other question that you highlighted about the margin dip. Could you please repeat that? What is the reason for this quarter gross margin dip?
Yeah. So, as you would have seen that our sales growth in the less regulated markets or what we call other markets is significantly higher this quarter than it was in previous quarters, mainly driven by the products, the production in Vizag, which we were selling in the less regulated markets. That was the key reason because of the sales mix between the two markets that you saw some reduction in margin. And we expect that to normalize as our sales mix in terms of regulated to less regulated gets more into the normal mode over the next few months.
Okay, that's helpful. But sir, aren't we seeing any kind of impact of the recently increased raw material prices that the industry is talking about? Are we seeing any impact coming on our basket specifically? And any comment on the industry level that you could help us with?
So sticking to Solara, to respond to your question, like with every other oil-based solvent, I mean, we've also seen our share of price fluctuations, but I've been very clear in emphasizing that we have really a very strong cost improvement program that's been running quarter after quarter in delivering, and we are able to mitigate to a large extent any fluctuations in raw material pricing through better sourcing, through better operations control, better yields, better recovery. So we're very confident that any blip in prices that could happen, most of it can be mitigated and has been mitigated in the past through our superior performance and cost improvement. So that will continue to be the case going forward, Cinderella.
But no major impact because the price rises have been very steep. We've been hearing 200, 300% rises. So we are well protected.
Yes, we are. And some commodity chemicals, acetic acid, for example, went significantly higher over the course of the quarter. But we've really been anticipating some of these, and we've been taking actions to mitigate costs either through smarter sourcing or better operations. So we've been able to handle that, and we will be able to do that going forward.
Also, around the pricing, I mean, we have seen some price declines in IBU, but does that have any impact over our businesses of now, or you think that our long-term contracting is being protecting us there?
So all our regulated market sales, which are on mostly on long-term contracts, has protected us. And we've always taken a long-term view with our customers. And, as I've always been saying, when there was a shortage and prices were different, then we've supported us. And whenever there has been a price fluctuations one way or the other, we work well with each other. So we are to a large extent protected. However, the less regulated space, which is all new market entry for us from Vizag, there has been an impact on pricing, but that is normal for the whole market, so nothing specific to Solara. Overall, we are well protected because of our sales mix, our long-term customer orientation, and the fact that we are predominantly in the regulated market space.
That's very helpful. One last question. You mentioned in your opening remark that there are certain more COVID-related products that you guys are looking at. If you could throw some more light on that, would be helpful.
So I said that a lot of parts, a bunch of parts we're working on. Some of them are COVID related. So I'll just wait for a couple of months before we really get into proof of concept stage, and I'll be more than happy to share the specifics with you, Cinderella.
Thank you so much. I'll get back in the queue, and all the best.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Service. Please go ahead.
Yeah. Thanks for the opportunity. So just extending the question of the previous participant. So broadly, how long the contracts are in terms of like number of years, if you could highlight?
So it varies depending on customers. We have contracts that are 5 to 7 years with customers. We have contracts which are 2 years with customers. So it's difficult for me to put a number to it in terms of the tenure of a contract. But it's when we say long term, it's typically at least a year, if not longer.
Got you. And on a ballpark range, like, what kind of like 10-20% kind of a price fluctuation you think that can be very well protected on the either side? The reason to ask is that let's say if the price of the product is $10 and if it goes down to 6 or 5, are we still protected because of this contract, or will we have the repercussions of the prices on the finished goods?
So like with every contract, right, it's never going to be digital that, if everything goes really high or really low, that there is no recourse to it. But typically these fluctuations are not happening. So we are well protected in terms of both margin and revenue by these contracts.
Understood. That helps. And secondly, just on the receivables, I see over a period of last 6 months, there has been good increase in the receivables. If you could just explain that.
Okay, let me take that question. In fact, receivables is more so if you see the kind of a sales mix which over a period of time is happening. Our sale in less regulated market or what we call it other market growth is much higher compared to regulated market, and the credit profile of the customer is very different when it comes to I'll say regulated and non-regulated. Typically, the non-regulated market customers work on slightly extended credit period. Since the mix is changing between regulated and unregulated, that has an impact on higher receivable what you see on our balance sheet. Second thing, of course, we have a growth. You are seeing quarter-on-quarter sales growth, and even in this quarter, 40% YOY growth. That also will have an impact on receivable, and that's what is getting reflected.
Okay, sir, that helps. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Ranveer Singh from Sunidhi Securities and Finance. Please go ahead.
Yeah, hi. Thanks for taking my question. So one clarity on regulated market contribution, what would have been from US, if you could break it up?
So roughly our total sales, 1/3 roughly is in regulated, US, North America. So we don't split it further, but we can do that. I would say roughly 30% or so should be from the US market, North America, US, Canada.
Okay. So why I'm asking this, because in annual report, you mentioned roughly 100 crore of external sales to US in FY20 annual report. And in presentation, I have been looking at this is showing 30% or more than this. So what is the disconnect? Is it in annual report mentioned some external customers? So what is the difference actually?
So there are sales that we make of the API into the US. There are sales that we make of the API to a formulator who ships the formulation to the US. So destination is to the US. So when we say 30-35%, that's including both. And the reason we do that is the pricing is dependent on the end market of the formulation, not the destination of the API. So that's why we report it like that. So when we say external sales, it must have been export sales to the US. When I say 32%, that includes sales where formulation eventually ends up in the US.
So we supply to formulator in India and they export it to US market. That's what you're saying.
Correct.
Okay. And what has been contribution of Vizag facility in this quarter?
So we don't split it by facility to give you the exact contribution, but I can tell you that Vizag currently is at two-thirds utilization, roughly around 60-65% utilization. And we've already stated the total capacity of Vizag in the previous presentations of around 3,600 tons of ibuprofen. So that's kind of where we are in terms of the total output from Vizag.
Okay, but are we maintaining that this facility can give peak revenue of 400 crore kind of sales?
Yeah, so 3,600 tons is the boilerplate capacity at Vizag, and as I had indicated earlier, we will be able to deliver that and ramp up to that capability as we had guided before in 6 to 9 months' time, and that's still what we are tracking to.
Yeah, because two-thirds capacity utilization should have been, that sales should have been significant, what I understand, if I consider 400 crore as a peak revenue.
So it depends on which market that we are going and the average price assumption you have maybe on a certain market level. So there are two factors into this. One is volume, the other is the type of market that we are selling into. And the 66% utilization is 33% or one-third roughly. We were already in quarter 3. Quarter 4, 2066. So, added another about 32% of utilization. And all the product is now going to the less regulated markets.
Okay. And one last, if I can, on ibuprofen side, are we see any change in, pricing realization from Q3 to Q4?
So we have now have more sales in the less regulated markets from Vizag. So there, the pricing is definitely lower than it is in the regulated market. So our price realization will be more a function of the market mix, less to do with the absolute molecule per kilo pricing.
But volume-wise, we are growing.
Yeah, volume-wise, we are growing.
Okay, that's it from my side. Thanks, Chandra.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking the question. But just sort of taking forward the previous question a little bit. So on Ibu, the 30% tons capacity, boilerplate capacity that we have in Vizag, that would have been, initial idea was largely to do less regulated market, or it was to do red market, just that we don't have approvals yet. We are currently servicing the less red market, and we will probably transition to red markets as time goes by when the approval comes through.
Yeah, correct.
Okay. And just as a very broad sense, typically, is there a major differential in the pricing that typically one realizes in these two sort of buckets?
Yeah, there is. So depending on the grade or which pharmacopoeia that the product meets, there is a price difference, and it could be as much as a couple of dollars per kilo.
Okay. Got it. Secondly, on Vizag per se, so the Vizag, the way to understand Vizag is there is obviously a phase 1 which is on the Ibu capacity. The phase 2, so that is all what is there in Vizag right now, right? The MPP is going to incrementally start working from this quarter onwards.
Correct, Nitin. So this quarter we will be commercializing the MPP, and that's where I had also indicated amongst the products that we will also be making favipiravir there.
Right. And the fact that we're going to be coming with favi capacity now, we obviously the wave 2 and subsequently everything is uncertain. So just can you give us a little sense on how is the market landscape like for this opportunity as we see it going forward?
So the facility is a multi-purpose facility. At this point in time, not just from a business but from a society perspective, we feel it's the right product to bring to the market. And in our partnership with Darur, we are bringing it to the market. And we will monitor the situation. And because of the fact it's a multi-purpose facility, we have the flexibility to change product that we make there in a couple of weeks' time, so 2 to 3 weeks' time. So that gives us the flexibility to do this product, support society, support business, as long as it makes sense. And then, of course, we can do other products in that facility.
Got it. And the last thing, so post commissioning of this MPP facility, the entire Vizag capex would have come on stream. Is that fair, or is there something more left in the Vizag unit then?
No, we are also working on additional capex opportunities. We'll come back to that once we finish the integration discussions and we come back with synergies, because it has to be now something that makes sense for the combined entity. So we're in the process of detailing that out.
Okay. Thank you.
Thanks so much.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Dipali from Samisha Capital. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Thanks for taking my question. My question was more on the Aurora Life Science. So, I understand that we'll come back with the details, but can you give us an indication of, how our, a little direction on how our balance sheet will look like in terms of our gross block, working capital, goodwill, post this integration?
So maybe I'll just say something and Subhash can add to it. Just to re-emphasize, as we had discussed during the merger announcement presentation, the management accounting figures are already there in the public domain. Those are still valid numbers to keep in mind as we talk of Aurora. Subhash, over to you.
Yeah, that's what Bharat I was about to say. We have indicated our Aurora number during our last call. The Aurora merger is EPS accretive right from year one itself, so that's a positivity. And the way Aurora financial ratios are, they are much healthier ratios, whether it's an ROCE or asset turn, so or even the EBITDA margin. So once we merge together, we expect our ratios to improve. More color to this, we'll come back once we complete our integrations. Planning, so you'll hear more from us after that.
Okay, thank you. And the other question, so we understand that Aurora also has significant revenue from COVID drugs. So then, just to give an indication of how the growth of Aurora will be, going ahead, will it be sustainable, considering that we have COVID drug sales as well?
So I think what we should do is we wait for the synergy, to complete, and then we will come back with much more granular details on this one. Just give us some time. We'll work it out so that we can have a good discussion with accurate data.
Sure. Thank you. Yeah, that's all from my end.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Shirish Jain from Apex Capital. Please go ahead.
Yeah, hello, sir. So I wanted to understand, in cash flow from investing activities, we can see 175 crores of capex, but the same is not translated into fixed assets or capital work in progress. So what am I missing here?
Hello, can you hear me?
Yes, sir.
Yeah.
Hear you now.
Yeah.
Okay. No, in fact, if you add back depreciation into that, you'll reach to broadly a similar number, because what you see in balance sheet is a debt block, not the gross block. Other thing, yes, there are some capital advances which are part of capex, which doesn't get reflected in asset block.
So, sir, these capital advances are to the these are pertaining to intercorporate deposits?
No. These are for equipment manufacturing. If you extend the capital advance, so it becomes a part of capex spending.
Okay. All right, sir. That would be all from my side.
Yeah.
Thank you. The next question is from the line of Kunal Randeria from Edelweiss. Please go ahead. Kunal, may I request you to unmute your line from your side and go ahead with your question?
Yeah, I'm sorry. Yeah. So good afternoon. My first question is on the composition of growth. This quarter seemed to be driven mainly by other markets. So how do you see this in the coming year? And I mean, if other markets are driving growth, is it fair to assume the gross margins will be lower year on year?
So it's a good question. So the key reason behind the other markets driving growth are, one, Vizag, so all of the quantity goes to other markets. Two, we have opportunities in other products in the other markets, which we were able to kind of capitalize on in Q4. As the situation normalizes in terms of the regulated market growth, that will happen as the demand comes back, mainly in Europe, as I had indicated that, there was some slowness in Europe for qualifying other sources, focus on, COVID therapy molecules mainly, not really spending time on other molecules. Those things we expect to normalize as Europe has seen some stability in terms of the COVID cases. So I think this will normalize and become more like it was in the earlier part of the year over the next few months. So then the margin profile, because of market mix, will not be impacted as it was in Q4.
Okay. So then for the coming year, I mean, you are saying that both your engines should deliver growth, right?
Correct. Because one of the priority areas for us, and this was actually a question 2 quarters ago in the same call that we are in today, about are we looking at other markets also as a growth engine? Are we heavily focused on regulated markets? At that time, I'd also very categorically said, for us, we want to be successful in both. And, we've been able to do that very successfully in terms of executing our plans. So I'm sure you will see that traction going forward, and you will see the balance come back to what it was before at a higher level in terms of regulated versus other markets.
Okay. So as a thumb rule, will US be higher prioritization followed by Europe and then ROW?
So in terms of, it depends, roughly you're right. Some products are a bit different between Europe and US, but roughly that would be a fair assumption.
Right. And any sort of rough, what would be the differential between US and Europe?
Yeah, that's a tough one. Depends very much on the product. So it's difficult for me to give you a number on that, unfortunately.
Sure. So my second question is on the CRAMS business. Now, post the acquisition, now you should be around 225 to 250 crore kind of a business. So just wondering, what are the kind of synergies that you see? Are there any revenue synergies or mainly it's on the cost line?
So there are revenue synergies because our customer base on the CRAMS side is different. There is opportunities that we are immediately able to see just looking at the customer base. And the second synergy we see is now the R&D part, right? So now we'll have 3 centers, gives us more capacity, more capabilities to be able to differentiate ourselves on the CRAMS side. So both of these will play a very positive part in terms of growing our CRAMS business from a synergy perspective.
Right. So, this is sort of oversimplified. If you're growing at, say, X%, after the merger, you can probably be growing at what, 1.05x or 1.1x or something like that?
Yeah, I would say it would be, much faster. I don't want to put a number to it till we do the synergy discussions, but they'll be much faster.
Fair enough. Thanks a lot, and all the best.
Appreciate it.
Thank you. The next question is from the line of Ujjwal from Quest Investment Advisors. Please go ahead.
Yeah, thank you for the opportunity. So I just wanted to know a bit more on MPP side. So Favipiravir is the one product that we are launching right now. If you can give more clarity about how many products you see getting launched during the year from this facility. Secondly, in terms of developed market approvals, you did say that, digital audits are being considered by the developed authorities. So any timelines in terms of approvals or any indication that you have received from any of the developed markets for possible audits, if you can throw some light on that, please.
So on the second question, we've all seen recently there was quite some, hearings in the U.S. Congress asking for the FDA to come with creative ways of clearing the backlog of inspections. Subsequent to that, FDA has issued a detailed guideline paper on remote inspections. How does it work? What are some of the criteria that should be used by companies to benefit from it? It's an evolving discussion at this point in time. So many countries, including WHO, are in the process of adopting remote audits. In fact, I just saw an example in Latin America where FDA had done a remote audit as recent as a couple of weeks ago. So I think the world is catching up with the fact that this process of face-to-face audits may be still a bit of a distance away in terms of timing. So that's the general view right now, and this is all based on what's available publicly, that more and more regulators are looking at remote audits and looking at that vehicle as a vehicle to continue to clear backlog that they may have in terms of audits. Just can you repeat your first question again, because the audio was a bit off in the first part of what you said.
Yeah, sir. It was about MPP. So you did guide to launching Favipiravir API first up. What is the total capacity of the MPP, and how many products do you think will be launched in FY22 or maybe a year ahead, if you can give some guidelines in terms of NPP ramping up over the next 2 years or so?
Sure. So as a company, and I'm not talking only Vizag NPP, but overall as a company, we will aim to have at least 10 to 12 filings this year. And that's basically what will be the new product launches that we will do. That includes not just the Vizag NPP, but that includes the other facilities also. And we will continue to file market extensions. Last year we did 23. We will continue to do at that level going forward. So that will be the amount of filings that we will do as we have planned for in FY22.
Great. In terms of the ibuprofen, you did mention that currently we are selling a large quantity in terms of volumes to non-regulated markets. Considering a year hence, we do get approvals from the developed markets, and we do shift some volumes over there. Are we planning to add more capacities to meet the non-regulated demand as well? Because we now could have created a base for those ibuprofen capacities in those non-regulated markets as well.
Correct.
So is that on the anvil, and what kind of CapEx are we looking for in FY22, if you can share?
So I'll answer the first question, and then Subhash will step in to answer the question on CapEx. So we continuously monitor the market situation on ibuprofen. We are very comfortable with our business model because it's based on strategic relationships. It's based on the fact that our products are customized to fit the large customers' machines and run them efficiently. It's based on the fact that we have a very strong presence in ibuprofen derivatives. And using these advantages and differentiators, we've been able to enter new customers in the less regulated markets over the last 4-5 months. And to the question of whether this would warrant us to add capacity as we get regulatory approvals, we will continuously monitor the situation. There is always the possibility to do more out of existing assets. There is always the possibility to debottleneck. So we will explore all options to continue to service the market. We have a very leading presence in ibuprofen, and we will continue to maintain that, and we're very confident of doing so. In terms of additional capacity, we will keep looking at the situation. If warranted, we have no problems in committing further to this business because we're very good at it and we are the leading player there. At this point in time, no immediate plans for that.
Great, sir. And lastly, on the CRAMS business, sir, in terms of the synergy benefits that you would be looking at, but only considering what Solara is or was doing till now, in terms of capability enhancements or in terms of new customer wins, you can throw some light on how CRAMS has evolved for us over the last 6 months, and Aurora obviously will add to a lot of other things once that comes in.
But we are losing your audio very badly. Can you come in a better reception area, please?
Yeah.
So we are still not able to hear you properly.
Hello?
Yes.
Yeah. Sorry for this network issue. I was just mentioning about the CRAMS part of Solara. If you can throw some light in terms of what new capabilities or new areas that Solara has worked upon, or new customer wins which will drive Solara's CRAMS business over the next 2 to 3 years. We do understand that Aurora and all would add a lot of capabilities in terms of R&D and customer base, but if you can throw some light on what Solara has been doing, which will augment growth for them.
Perfect. So, it's not an either or, as you very rightly point out, it's an and. So it's Aurora and Solara, both of us adding to the growth. Solara's strategy on CRAMS has been based on making sure that we have adequate differentiation in a solution we bring to our customers, to deepening our engagement and our efforts to gain more from big pharma customers, which typically are very sticky and are long-term oriented. Third, we continue to look for inorganic opportunities to grow our CRAMS business, looking for assets/lab in the West mainly, but not really only in the West, but we are preferred to have that in the West. So these are the 3 elements of our strategy. In that, we are making very, very good progress on making sure that, as I said at my opening remarks, we have added just this FY21, we've added about 4 big pharma to our customer list. We've got repeat inquiries from 2 of them as recent as last quarter, and we're very deeply engaged with all of them. in terms of providing solutions to them. And we are very confident of the track and the trajectory in which these engagements are going. Coming to the point about geographical spread, which is also equally important for us, we've made breakthroughs in CRAMS in Japan, we made breakthroughs in Korea, and we're strong in Europe. We continue to make small breakthroughs in the US. So all of this is what gives me the confidence to say that CRAMS will grow at a faster clip than the overall company. And these leading indicators of wider geographical spread, big pharma customers, along with the fact that we're doing the right things from a scientific differentiation perspective, is what we believe is the propeller of growth for our CRAMS business. And of course, the inorganic will leapfrog this even further. For now, I just commented on the organic part of how we're growing.
Great. This is really very helpful. Thank you. Thank you so much.
Thanks.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking a follow-up. Bharat, just going back to your earlier comments around the new product launches, the two products that you mentioned, that you will be launching in Q2, Q3, any qualitative sense you can give us all the opportunities? What kind of products are we talking about here, and an potential opportunity which can play out over a period of time on these products?
So these products could both combined together could be total market potential / our opportunity size could be in the tens of crores at full blown both together. And I'm being a bit guarded in saying an exact number because we're still in discussions with multiple customers. Both these products are competitively not very intense. We are one of the very few players. Our process is very differentiated from our competition, and that's why we have this significant traction with customers. As I said, the capacity is fully booked for the more or less a whole year now for both these products. So it would be in tens of crores.
And these would be what? When you said Q2, Q3, this is the market formation timing coincides with the market formation.
Correct. So Q2, Q3 will be scale up. So we're already the exclusive supplier of this product to our customers, and this will be scaled up in Q2, Q3. We are scaling up the API production as we speak. So the revenue impact and the margin impact will come in Q2, Q3.
And these would be relatively better margin businesses for us versus the corporate margins? Okay.
It will be better margins.
Perfect. And secondly, on the new technology platform that you talked about, can you give us a little more understanding on that? The scale up with there?
Sure. So in previous conversations, I've been sharing that we are very serious about differentiating our ability to bring a solution to our customer. And we have invested and spent time on developing what we call technology platforms. And without going into the details of each of the technology platforms or what they are, and I'd rather just come back to you once we have it. But as an example, I'm getting some background noise. I'm not sure.
Then may I request a major line from your side, please?
Yeah. So thanks. So technology platforms, and I'm not saying these are the ones we're working on, but just to give you an example, right? Biocatalysis is a technology platform. Flow chemistry is a technology platform. Fermentation is a technology platform. So what we are doing is we're bringing complex generics is another technology platform. So what we are doing over these few months and what we have been doing and will continue to do is invest in developing the capabilities, which means that we will have the competence to develop a product that needs this particular technology. And we anticipate to have at least 2 of these in terms of proof of concept by the end of this financial year. What this does in the medium to long term is gives us an opportunity to participate in a market space with very limited competition, higher margin profiles, strong customer stickiness, and alters kind of the way that we work with our customers, partner with them on launch, partner with them on other strategic market entries that they may have. So it just kind of gives a totally different perspective to the business that we would have at that point in time. So this is what we mean by technology platforms, and that's what we are working on currently. And as we come to the proof of concept stage, I'll be more than happy to share more details, how we see ourselves different and competitive there.
Right. Thanks. One last question. So when we look at our new product launch contribution to our revenue, it's about 7% or thereabouts, if I remember we mentioned in the presentation. Now, how do we measure if this is what the product to be launched in FY21 or there's a certain longer time period that we use? And 2, do we see this proportion, whichever way we define new product launches, significantly changing for us as we go forward?
Yeah. So we define any product that has been launched in the market over the last 3 years. So anything that's 3 years and less, we take it into account in terms of new products. we see 10 to 12% as steady state for new products. And I think the part of it was 7 in Q4, but it is 9 for the annual number. So we were close to that 10. And again, Q4, again, less regulated markets entry of ibuprofen skewed that ratio a bit. And as we scale up the new products, I'm confident we will be in the 10 to 12 percentage number. And it's a refreshing metric. Every 3 years, something drops out, something gets added.
Got it. Thank you, and that's all.
Thanks, Nitin.
Thank you. The next question is from the line of Harshil Patel from Sharekhan. Please go ahead.
Good afternoon, sir. Thanks for the opportunity. Sir, just need one clarification on the capex. As you said, we've incurred about 174 odd crores for 21. So, sir, what can it be for 22?
Yes, let me take this question.
Yes, sir.
In fact, last time we spoke about CapEx, if you remember, in our last call, and since we are in growth journey and we expect our growth to continue, so our CapEx even in this year will be in the range of 200 to 250 crore. But we are also in middle of our synergy discussion with Arrow. So most our calibrations, once we understand their capacity need, our capacity need, you will hear a number once we come back with the guidance for this year, how this number will be, taking Aurora also in consideration.
Okay, sir. Thank you, sir. That was it.
Yeah.
Thank you. The next question is from the line of Alisha Mahalwa from Envision Capital. Please go ahead.
Hello, sir. Thank you for taking my question. Just one clarification. What is your capacity utilization currently if you exclude Vizag?
So other than Vizag, if you see, it will be close to mid to late 80s.
Okay. Got it. And just some comment from you in terms of what is the percentage of import of raw material and currently how much of that is coming from China?
So total imported raw materials is roughly around 35-36%, out of which 29% comes from China, which is a reduction from the 32-odd% it was in the early part of the year.
Okay. Thank you so much, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Sachin Jain from Carnelian Asset Management. Please go ahead.
Hi, Bharat. Thanks for taking my question. Could you more elaborate on your scientific on CRAMS side? And why customer would come to you? If you can elaborate more, you already elaborated a bit.
Yeah, sure. See, the CRAMS business is all about capacity. It's all about scientific differentiation, all about making sure that we are adding value to a recipe that a customer has already thought of or wants you to develop. So what we have been focusing on over the last 1 year and kind of very well anchored in the DNA of the organization now is CRAMS at the end of the day is a technical/science sale, where you have adequate capacity that can back up your science, and which means you can make that product, and you have the adequate knowledge and the scientific capability to be able to develop that product for your customer. So that's how we have differentiated ourselves on the CRAMS space. All our discussions with Big Pharma, and I'm personally involved in a few of them, so I can say this from experience, has been about how we can do something in a way that is unique compared to either competition or compared to some of the ideas the customer themselves may have. And that is what has given us repeat opportunities. Not that, we've gone and said that, we have capacity and that's important, but it's also the scientific capability that we bring to the table. And that's how we've been able to get repeat business with Big Pharma customers. And that's what we are expecting to further build on in terms of strengths and further grow that capability.
Thank you. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, we will take the last question from the line of Kunal Randeria from Edelweiss. Please go ahead.
Thank you for the follow-up. Sir, my first question is actually on related to COVID products. So just wondering, how you price these contracts, because let's say the government caps the formulation prices. So do your prices to your customers also come down accordingly?
So it's a bit premature for me to comment on that because we're still in the process of commercializing this product. But of course, we will comply with whatever the government regulations are. We will work with our customers to make sure that at the end of the day, both society and business benefit. It's not one or the other. And we will focus with our customers to make sure that we are doing the right things in terms of pricing, commercial arrangements, all of these things. Unfortunately, I'm not able to give you more color because it's a bit premature for me to comment because we're in the process of commercializing as we speak.
Fair enough. And just my last question, it's on the capex number. So out of this 250 crores that you are planning, how much would be maintenance and how much would be, for capacity addition, and where exactly are you adding capacity?
No, in terms of maintenance and growth capex, majority of this capex is a growth capex. If you see the maintenance capex is not very high in our industry, so majority of the capex is coming on growth. Where this exact capacity is coming up, I'll say just wait for till we come back with our more color on post synergy, how and where this investment is going to come back.
So just to add to Subhash's comment, we've already been sharing in the past that we have land available, and I think Alankar asked the question at the beginning of the call. We have land available in Mysore, we have land available in Vizag. So it's a question of just identifying the right product, the right capacities, and then installing it. So that's kind of how we are in the process, as Subhash explained.
Okay, got it. Thank you.
Thank you very much. I will now hand the conference over to the management for closing comments.
Thank you. And once again, thank you all for joining today. And, I want to again give the best from all the 3,000 employees of Solara to you and your families to stay safe, stay healthy, and, look forward to connecting with all of you in the coming days in further calls. Take care, stay safe. Thank you.
Thank you very much. On behalf of Solara Active Pharma Science Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.